Hi, and welcome to Barnes Dennig Ask the Experts. I'm Marketing Director Kat Jenkins, and today our state and local tax pros, Dave Walls and Ryan Lauer, are talking about some common sales tax compliance issues and how to avoid them. Dave and Ryan, it's great to have you with us.
The pandemic changed buying habits for both businesses and consumers, and that means expanded operations for many businesses. And while these changes can mean great things for your bottom line, they may have also raised sales tax compliance issues. Dave, what are some of the top issues that cause new sales tax compliance concerns?
Well, thanks, Ryan. One of the big areas of concern for sales tax compliance is the expansion. Companies expanding, whether that's property. A lot of companies have inventory in multiple states now. It might be sitting in a warehouse in another state. That can cause sales tax compliance. Or they have people working in other states. With the pandemic, we're having more and more people that are working from home, and they may be an Ohio company, but they got an employee in South Carolina. So all of a sudden, you have Nexus and compliance concerns down in South Carolina or Florida or wherever that employee might live. So that can cause some problems where they haven't filed in the past. And on top of that, we got companies that are doing internet sales. Almost every company nowadays is selling something through the internet. And a few years ago with the Wayfair case, it allowed the states to now require companies to register and file sales tax returns in a state where maybe they didn't in the past. The law basically now says in most states, if you have 100,000 of sales in their state, that can require you to register for sales tax, start collecting sales tax and remitting it, which is a big compliance responsibility, a big burden for a small company. And $100,000 is fairly small in the scheme of things. And a lot of companies get caught up in that compliance. On the other side, then you got companies that are doing a lot of acquisitions or mergers in a state. Depending on how that company that they acquired was doing their compliance activities in the past, now you may have new compliance concerns. You may have to look at that and see, were they on top of things, and now do you need to do something different and add that to what you're doing currently. And then the states, with the pandemic starting to slow down a little bit, more and more states are looking for money. So they're out there doing their sales tax and even their income tax audits. So their activity is picked up. And if one of the first companies they're looking at are the ones that aren't registered and aren't filing, but they know you're in the state one way or another, they can find you. And then, that's where they come after you on the audits. So we want to kind of get in there and reduce any penalties or interest by catching that on the front end. And then, we always tell companies, hey, if you haven't done a state tax review for a number of years, or if you've never done one, now's not a bad time to do it. With everything going on in the world and all the new expansions, and like I said, everybody on the internet, it's a good time to do it now. At least know where your exposures may lie and how to proceed going forward.
What are some of the areas of state tax to look at?
Probably the top area, and the first area we usually focus on is what's called a Nexus study. And basically Nexus is the requirement that a state says you've got enough contacts with our state. You had enough sales or you had property or payroll in our state. We now can require you to register and file. Nexus studies are ever evolving and changing. States keep changing their rules. Companies are expanding. Like I said, everybody's on the internet and selling. So all of a sudden you can have a requirement to register and file in that state. So you need to look at it. And even if you've done one in the past 2 or 3 years, if it's getting stale, you probably need to update that and look what's changed, and what should you be doing going forward. So that's a big area to look at. You kind of know where your exposures are, or just to know if you're doing things correctly. Another area that's good to look at is what's called an apportionment review. This is more related, not so much to sales tax, but to income tax filings. And when you're looking at income tax, the way states allocate income and situs it to that state for an income tax purposes is based on what they call apportionment. So if you're a manufacturer, you situs it one way to a state. And now with service businesses, it's really changed. So service businesses do it different, the way they situs their sales. So you need to look at those. And if it hasn't been reviewed for a while, that probably needs to be reviewed more currently to make sure you're on top of that. And then a big area that a lot of companies don't have time to look at are tax incentives and tax credits, which we'll talk a little bit more about in a few minutes. But tax incentives can help reduce the cost of going into a new state. You're doing an expansion, but maybe you get some incentives for moving to that state, and it's always good to review and see what's out there that you can take advantage of.
Can you tell us a little about exemption reviews for sales and use and CAT tax?
Yeah, exemption reviews, it used to be called, a lot of companies call it a reverse audit, but it's basically just looking at what activity you're doing and where there could be an exemption from the tax. So if you're doing R&D activities, a lot of that equipment would be exempt. For example, Ohio, Indiana, most states have some type of R&D exemption from sales tax. There's also things for pollution control, for things, a lot of warehousing type entities, a lot of their equipment can be exempt. Transportation companies is a big one. If transportation companies, are a lot of exemptions for their vehicles that they buy or any ancillary equipment that's used on the vehicles or with their business. And probably the biggest one are manufacturing companies. Manufacturing companies are, in most states, are awarded so many exemptions for their equipment, so their property, anything they're buying can be exempt. One of the biggest concerns we get there is some of the manufacturers have been told, hey, you're a manufacturer, you're exempt, but you're not exempt on everything. It's got to be used in the process. So it's good to always review and say, hey, you bought that forklift that's used in your warehouse, that may not be exempt. Or here's a computer that's used in the office, that's not exempt. But just because you're a manufacturer, you may not get that exemption. But there's numerous exemptions, and if that hasn't been looked at, it's a good time to look at it before an auditor comes in. And it's also good to look at when they're in there auditing. We could go in and do, like I said, what's called a reverse audit, look at those exemptions and hopefully offset anything they find in an audit.
And of course, as you mentioned a minute ago, everyone wants to know about tax incentives. What are some key areas there?
Right. There's just a number of incentives. Every state is trying to attract the best business and get people in their state working. So a lot of these credits are based on people or property. If you bring people in, so in Ohio, for example, one of the big ones is the job creation tax credit. So if a company is going to add maybe 10 employees, usually you want to be more than that, but 10 employees is enough to actually see if you qualify for some state tax credits. And the job creation tax credit is not only at a state level, but most of the cities also have a corresponding credit that piggybacks off the state, can provide you money for hiring those new people. They also have training grants and hiring grants that are available on a limited basis as well. They have a credit called an Invest Ohio credit, where that's for small business owners. If the business owner is putting money into the business, so they're going to put $1 million, say, into a business venture, they put it in there, they can actually get up to 10% of that back as a credit on their individual income tax returns. And a lot of people just miss that. And it's something that comes up every couple of years. It gets, seeing how much money is available for those type of credits. But then there's, like we spoke about before, R&D. Even those are exemptions on one side for sales tax, there's also credits kind of piggyback off what you do for federal. So if you take the federal R&D credit, most states have a state R&D credit. And where we use that, I've seen companies that say, hey, I don't take the federal credit because I haven't made money the last few years, so I can't even use it. But for Ohio, for example, it goes against the CAT tax, and everybody pays some kind of CAT probably. So it can reduce your CAT tax and could be carried forward. And then there's things like enterprise zone. So if a company's doing an expansion of property, they can get up to 100% abatement on their real property expansion. They're buying a new building or just adding on to a building. They can get those abatements, and then there's some ancillary credits there. So that's just a few of the numerous credits that are available and exemptions. Almost every state has something, and if it hasn't been looked at, it's a good way to help on the ROI for doing that expansion and help with that. So that's just a lot of the areas of state and local that we like to look at. And I think that does it for here. And I guess we'll go back to Kat.
Fantastic, Dave and Ryan. Thanks for those insights and information on tax credits and incentives. A lot of great information there. If you have a question about tax credits, tax incentives, state and local tax, whether you have Nexus or would just like to set up a conversation with one of our state and local tax pros, you can contact us at barnesdennig.com. We'll see you next time on Ask the Experts.